We are continuing to track some of those stocks that were hit hard by the block sale stemming from hedge fund Archegos earlier in the week. But Jared, you've been looking at some takeaways for retail investors, and this is an interesting conversation because when you think back to what happened during GameStop, the meme stocks, the constant thing we heard was let the professionals handle it. They know better. And yet this seems to suggest that that's not necessarily always correct.
Yeah, well, the entire hedge fund industry is centered around giving people who can take incremental amounts of risk and then ramp it up. And if they do well, they just get piled on more money, more money, more money. And eventually they tend to blow up. Most hedge fund managers will blow out a fund or two before they really get started. And a lot of hedge funds have multiple funds that they're managing. So the big takeaway for me is that the risk managers didn't do their job. If you didn't pay attention to GameStop and Reddit and knew that there was potential for a huge short squeeze in one of your positions, things going the wrong way, especially when they're so concentrated in relatively illiquid names that aren't heavily traded, such as Discovery Class B shares. That was kind of the name that we were looking at yesterday. That stock popped by over 100%. You can see over the last 5 days, still up 79, 80%. The takeaway here is these guys are getting bailed out, but as a retail investor, you're not going to get bailed out. You lose money, you have lost it. It's gone. And you have to have a plan in place that allows you to make risk and allows you to keep swinging, because if you run out of money, guess what? You can't take that next great trade. So I think these portfolio managers at hedge funds on Wall Street, they get a little bit wrapped up in their positions. And in this particular case, they had they were arbing Class A and Class B shares for Discovery. So I want to show something. This is a comparison chart of the two different stock classes. So they technically have two different tickers here, Disc A, Disc B for the different shares. And you can see what happened yesterday. Normally, these two lines are supposed to go along pretty close to each other. They get out of whack. They'll short one and go long the other and plan on an eventual convergence. That's not happening. What we're seeing is a short squeeze in the B shares, and that is just causing massive losses. Now, the other lesson learned is if you're a bank, you got to jump on these problems right away. Credit Suisse, Nomura, they got left holding the bag. Deutsche Bank, they were able to sell a portfolio of some of the assets that they were able to confiscate in the margin call for $4 billion. So they said yesterday that they got out relatively unscathed. But for the retail trader, biggest takeaway here is you're not going to get a Fed orchestrated bailout like long-term capital management in 1998, and you're not going to get a hedge fund just funneling billions of dollars if you happen to drain your account.
Yeah, some important context there. Thanks so much for that, Jared. We're off for another break, but we'll be right back.